Hi, guys. Welcome back. Again, my name is Tanya, and welcome to my page, Essential Facts, where I talk about things that are going on in the banking industry, such as, credit card rates, credit cards in itself, credit, collections, mortgages, auto loans, whatever you want to talk about. And there's just so many categories within those to talk about. So, what I want to talk about today is interest rates. So, I know a lot of people don't understand how interest rates work and how you establish interest rates. I think that most people, just from my experience over the years, they look at an interest rate, tied it to, if my credit is good, I have a good interest rate. If my credit is so-so, it's going to be a higher interest rate. If my credit is not good, it's going to be a very high interest rate, or I may not be extended anything at all as far as credit. So let's just understand what interest rates are and the type of rates you have that are tied into different types of loans and payments. So first of all, I want to start with, and I'm going to look at my notes here because I want to make sure that I hit what I want to hit here. So, I don't know how many of you actually know what the prime rate is. So, prime rates are, or the prime rate actually is a rate that is set by the Federal Reserve Bank, which is the federal government. So, the Federal Reserve sets a rate, and it's a rate that banks allow their best customers to borrow at. Now, here's the thing, it's a caveat. Right now, the prime rate is at 7.5%. Up until about a month ago, it was higher, it was a quarter percent higher, but it dropped twice within the past quarter, not including this quarter here, not the first quarter of 2025. So now the prime rate is at 7.5%. Here's the thing. So when you get a credit card, or um, if your rate is based off of the prime, and not every type of loan or credit card rate is going to be just tied into the prime rate like that. So let's just take credit cards, for example. You apply for a credit card, they give you all the disclosures and everything on the application, and then you get this long page and a half of disclosures. Should you be approved for the card, and that you'll receive every month because the rate can change sometimes, and it's a twist to that. But nonetheless, that if you open a credit card, and I know like many credit card rates now are like just astronomically high. They're like insane. Like banks are charging like 20, 30% for interest rates for credit cards. I mean, and this is what people who have like good credit. So it's sad. 18%, 19, 25, 30% is nuts. But so you have the prime rate of 7.5%. And what banks do when they establish your rate on the credit card is that they take that prime rate, because in the US, we generally use the prime rate for credit cards. They add a margin to it. So that margin that makes it, or the interest rate higher, is a margin that a bank adds to it based off of your credit worthiness. So they're taking a 7.5%, and the margin, it could be 2%, it can be 10%, it can be 20%. So if you take the 7.5% where the current prime rate is, 7.5%, and let's say they add 10 a 10% margin to it. Now your rate is 17.5%. And that rate is a variable rate. Banks seldomly do not offer fixed rates for credit cards anymore because they just lose money when that happens. Unfortunately, that's just, what it is now. And they haven't done that in like many years. So now you have your prime rate of 7.5%, where we're currently at right now. Plus, again, like I said, I'm going to use a 10% margin. Just as an example, it could be any number the bank established based off of your credit worthiness. Now your payments are going to be based off of the 17.5%. So what the bank does, they take your average daily balance, take your average interest, and that's how they come up with your payment, or I'm sorry, the amount of interest that they are going to charge you. Now, the payment can be based off of 3% of the balance. It can be based off of 5% of the balance. It just depends on that bank how they want to do it. Banks have their own method. As long as they are within federal guidelines, they're going to establish the rate how they see fit and what's comfortable with for them. To be quite honest with you, so we know we have the prime rate. So I just want to make sure. Give me a second here. So the prime rate can adjust. So if the prime rate um, moves, then your interest rate moves. Prime rate goes down by 1/4%, your interest rate will go down by 1/4%. If the prime rate goes up by 0.5%, your interest rate goes up by 0.5%. So it just depends on how the prime is performing, is what you're going to be charged for interest on your balance. Okay, so the next thing I want to take a look at is the type of loans that we have out here. So people, there's so many different types of loans that are out here. You have your installment loans, you have your mortgage loans, which are more of an amortizing type loan. You have your fixed rate loans, your variable rate loans, you have your interest only loans, and you have your balloon loans. So, and then of course your installment loans, I think I said at the beginning. But nonetheless, there's different types of loans you can have. So let's go with like your fixed rate loans. So if you have a fixed rate loan or just a fixed rate product, like I said, just let's just say you take a unsecured loan and it's a fixed rate. So you have that rate set for the entire um, duration of the loan, whether it's 36 months, 48 months, or 72 months, however long you take it out for. That rate will not fluctuate. And it's the bank setting the rate under a fixed rate. Usually, if it's a fixed rate, they're setting it under a fixed term. So that's again on why you get the 36, 48, or 72 months. A good example of a fixed rate loan, again, like I said, it's a mortgage loan, but it's kind of a subdivision of what that fixed rate loan is with a mortgage, which I'll get to here in a moment. You also have your variable rates loans. Variable rate loans can be, again, it can be an installment loan, a personal unsecured loan. It can be an adjustable rate mortgage. That's a variable rate. And I'll go into that in a moment with the adjustable rate with the mortgage loans. That is basically the variable rate again is tied to the prime rate again, and it's the bank or the lending institution setting the prime rate plus whatever margin. Now, some institutions, if you're a good customer or they just run a certain promotion, it's highly unlikely it's going to ever you will ever see it for a credit card. You may see it for a home equity line, where they may take the prime rate and subtract from the margin. So they can subtract from the margin. They can take that 7.5% and they can subtract, 0.5% from it, and that's your interest rate based off of it. It's a variable rate, but no matter how the prime rate performs, you'll remain, whatever that percentage is, if it's 0.5% or 1/4% under prime, that's how you will always stay that percentage under prime, which is not a bad deal. It's actually a very good deal because most banks are actually adding to the margin. That's how they're making their money from the interest because, if they're letting you borrow money at the prime rate, the rate where the federal government has established um, for where banks can, let their customers borrow for their best customers, they're adding a huge margin is great for them. Now, I can tell you that banks do borrow. Now, when they're borrowing money, they're not borrowing the 7.5% what the prime rate is. They're usually borrowing about 3% lower within other banks. Now, the Federal Reserve is a bank. So when you have your banks out here borrowing, your commercial banks or large banks out here, or whether it's a savings and loans bank, they're borrowing money. They are borrowing money usually about 3.5% lower than what the prime rate is. And then they turn around and charge the customer the actual prime rate of 7.5%. So, obviously they're not going to, they have to make money from it. So they're not going to let you borrow from from what the bank is not going to let you borrow from what they are borrowing from the Federal Reserve. Okay, so then you have your amortizing loans. Those are mostly your mortgages. Amortizing loans are they're I like them, but like I say, you're just going to mostly get those with mortgages. You're just not going to really get them with any other loans. I mean, I'm not saying it doesn't happen. Like I said, it just all depends on, that institution, what they're offering. But an amortizing loan, it is normally going to be a structured payment like mortgages are. Let's say it's a 30-year mortgage and your interest your payment is based off of, um, or your loan is based off of, your principal balance and the interest that's charged. That's broken up over into an installment, whether it's, 30 years or 20 years or 15 or 10 years, however long you take the loan out for. The nice thing about amortizing loans is that the interest is going to be based off of what the balance is during that loan. So, you know, if you make if you make a large payment on a mortgage, you do have that ability to say apply it to the principal and they can apply it to the principal. Now it's a lesser amount of the principal that the interest is going to be, based off of. So your interest is not going to be as high. So that's the nice thing about like mortgages because it does give you the flexibility to be able to, just pay down the loan quicker should you come in like extra money or have the ability, drop extra towards the principal. Now I know some people, want to try to like just pay, hey, can I just pay this towards the interest? I mean, some places will allow you to do it, some don't. I mean, the main thing is you want to get the principal paid down because if the principal is lower, you're going to pay less in interest. It's still set over that term that you set up with the bank. It's just that you made a larger payment and now, you're going to be paying less in interest because you knocked down more of the principal. So that's the nice thing about amortizing loans. And another thing, like with, I want to go back just really quick to like your variable rate loans. And you see this mostly again with mortgages, and they're called your adjustable rate mortgages, meaning that it could be a 5/1 adjustable rate, a 3/1, a 10/1. Again, it just depends on what that bank is offering. Mostly you're going to see is like a 3/1 adjustable rate mortgage or a 5/1 adjustable rate mortgage. The way that is set up for you with the interest is that you have a set interest rate. So it's a 3/1. Let's go with a 3/1. And you can put whatever number in there to 3 to 5 or 7, whatever. So let's just talk about, let's say it's a 3/1 adjustable rate mortgage. And let's say the interest rate, is at 6.85%. Okay. So for the first 3 years, you have a guaranteed rate of 6.85%. with this adjustable rate mortgage. 6.85%. That's a guaranteed rate you have. Now, after the third year, the rate can adjust every year after that. That's why it's called a 3-1 mortgage adjustable rate. A 3-1 is 5 years. You have that guarantee rate for 5 years. And then after that, every year the rate can adjust. So they say it can adjust. Let's just be honest, it will adjust. The bank is not going to hardly leave the rate the same, year after year after the adjustable rate term is up. But banks will give you the option to lock in the rate. Now, it's not going to be what your current rate is. It's going to be what that rate is at the time they're offering, or what the rates are at that particular time when your adjustable rate expires. So yeah, I just want to throw that out there too. I mean, it's a lot more to it, but that's a different segment with mortgages. The other interest you have to deal with is like interest only loans. With interest only loans, you have a loan where it is set up where you're just paying the interest on it. And you have some home equity lines set up like that. And, I would tell anybody, just do not do a interest only loan. You're just not going to come out looking good in the end, because that interest is only set up for a certain period of time. So again, whatever time frame the bank has established, whether it's a year or it's 3 years, it's 5 years, and then you take the next 20 years paying, principal and interest, you're going to be upside down, or darn near upside down on that loan, or owing so much more on that loan because you paid nothing towards the principal. You do want to get a loan where your payments are being applied to the principal and the interest. Okay. We also have your balloon loans. And balloon loans are kind of like adjustable rate mortgages almost. They allow you to have smaller monthly installments or payments. It could be for 5 years or whatever time frame the bank has established for that particular product. Then after a certain amount of years, you have this balloon payment, this huge payment that's due. A lot of people got in trouble with balloon payment loans and interest-only loans, which was part of the reason why the mortgage market crashed back in 2008. Banks were loaning out money to customers and borrowers who really couldn't afford the home, but if you're paying just the interest on it, you can afford it. Or if you're doing a balloon payment and you're paying a smaller payment, and then when that balloon payment comes due, you don't have the money for that large payment. Now, okay, you have a serious problem. You have a major problem. So, you have to be careful when you're talking about like interest rates and different types of loans and things of that sort. The best thing to do, and I'm going to caution you when you get a loan, know what the term is. Obviously, does a term make sense for you? Sometimes it might make sense for you, but depending on your financial situation. Hey, I'm going to take it out a longer term, but you're going to pay more interest, and it's going to be a higher interest rate. And I'm saying this example is for auto loans, especially, or personal loans, where the longer you draw out the term, the higher your interest rate is, because, well, it's more of a risk to the bank because you're taking it out longer. So they're going to charge you a higher interest rate, even though your credit is good. I'm not going to say it's going to be the same interest rate as, your credit score is, 730, and, Joe Schmo's credit score is, 640 or 690 or whatever, and they decide to give them the extended credit to them, and you both extend out to the same term. Yeah, is your interest rate going to be lower 9 times out of 10? Yes, but it's still going to be higher because you extended out longer. Will Joe Schmo's interest rate be higher? Yeah, it'll be much higher, obviously. But again, I say everything is based off of credit worthiness. And when you get loans, again, I always say, if you can help it, don't do interest only. It's just, like I said, it's just not going to benefit you in the long run. It just really isn't. And you always want to know everything about the loan first. Now, some of these loans have annual fees attached to them, be careful with that. Make sure you understand the interest, how it calculates. It's okay to ask, you know, how do you calculate the interest? It's okay to ask that. If the person can't answer it, okay, I need to speak to someone who can answer the question for me. I mean, this is your finances. This is your credit that you have to preserve, and you're the one making the payment. So you want to make sure that everything is doable for you. So, what I'm going to do at this point is I am going to pause it right here because, like I said, there's a lot more that goes along with, certain ones I'm talking about are these loans like fixed rate mortgages, credit cards, auto loans, things of that sort. If you have any questions, let me know. Hit like, please subscribe. I love doing this. I love sharing what I know. And if you have any questions, definitely leave it in the comment. And I just want to be there for you. You guys have a great rest of your day, and I'll see you next time.